What's up YouTube? Dougie Chong here. Welcome to today's episode where I'll be reviewing Keyera Stock. Keyera Stock, or ticker symbol key.to, is very similar to Enbridge, just a smaller player in the oil and gas space. If you didn't see my previous video on Enbridge stock, I'll leave a link in the description below. I really did not want to do another company in the oil and gas sector, but that is just where the deals are right now. The company Keyera is headquartered in Calgary and was founded in the year 1998 and makes most of its money from transporting and storing oil and natural gas. As I mentioned earlier, they are a smaller company. They only have close to 1,000 employees as opposed to Enbridge, which has close to 10,000 employees. So is it better to invest in a bigger company or a smaller one? Well, it really depends on the company. Usually, larger companies are more stable investments, but it is harder for them to grow. This is a bigger problem for tech companies which need to constantly be growing. But as for oil and gas companies, I really don't think there's much growth left to be had. A bigger company like Enbridge will have better brand recognition, which will typically push the stock price higher since more people know about it. The major downside with larger companies is that they typically have a lot of overhead, and if they need to downsize or shift directions quickly, they usually cannot. Alright, now let's dive more into the business model of Keyera. To sum up the business model, they mainly deal with storing and transporting oil and natural gas. They have interests in about 19 gas plants across Western Canada, and they have over 5,000 kilometers of oil pipelines. That's a lot of infrastructure. These are gigantic revenue generating assets, and they will continue to be so until we stop relying on fossil fuels. Now I'll go over some of their investor highlights from their latest quarter. It's important to note that I took these investor highlights directly from their website, so it may be a little bit biased towards their company. Probably the most important highlight is that they have a payout ratio of 54% and plan to continue their dividend payment with no decrease. For those of you that do not know, the payout ratio is their dividend price over their earnings per share. 54% is not bad at all. It means they could lose about half their earnings and still pay the same dividend. And a lot of companies have payout ratios of 100% or even more. Those are the ones that are really unsustainable and you really should try to avoid. A lot of those companies are just trying to entice retail investors with high dividends just to cut them in the future. Seeing the Pipestone gas plant project commence 5 months ahead of the anticipated schedule is a very good news to see. Almost always companies are late on deadlines. This goes from small companies to the TTC and even the fast growing companies such as Tesla. And finally, seeing continued investments in 2020 shows the company isn't just relying on what they have already done. Now let's look at some of the numbers. The last trading day saw a pretty big drop of close to 5% as the stock closed at $18.05. That's a pretty big drop for just one day. If we zoom out to the 1 year chart, you can see the stock was trading around $40 before hitting a low of around $10 when the whole pandemic started. So today's price is low, but still not that close to the 1 year low. And if we zoom out to 5 year chart, you can see that the stock was fairly consistently high before this year. A stock with a business model as solid as natural gas and oil should be fairly consistent. I think the massive drop-off shows that investors believe the time of fossil fuel companies are coming to an end. Stock prices always predict the future of companies, so even though nothing has changed yet, the lower price shows investors' pessimism for companies that rely on non-renewable energy sources. If we look at the market cap of Keyera, it sits at $4 billion, so it's not a small company, but it is a fraction of a company like Enbridge with a market cap of $72 billion. Its dividend yield sits a little over 10%, which is great, especially since the company plans to keep up the dividend for the foreseeable future. Its PE ratio of 25 is pretty good and shows that the company is not too overvalued. Now let's take a look at the balance sheet. One of the investor highlights was that they had a strong balance sheet, but it's always good to double check. Their assets and liabilities combined with stockholder equity are actually the same, close to $7.5 billion. A lot of the debt is in the form of stockholder equity though, about $3 billion, and this is good because it is better to be indebted to shareholders who ultimately want the best from your company rather than from external parties. Those external parties simply want to get their money back and typically want it as soon as possible. So is Keyera stock a buy in my opinion? Again, this is just my opinion. I am not a licensed financial advisor and this is not legal financial advice. But in my opinion, based on the price action, I simply cannot buy it at this point. I will, however, be watching it closely. If it drops another $1 or $2, maybe then I'll start to buy a few shares. A much bigger player in Enbridge is already pretty much at its 5-year lows, so I'd much rather invest in a company like Enbridge rather than Keyera. But if you want to diversify your investments or simply invest in a smaller cap company, then maybe a stock like Keyera is right for you. Let me know what you guys think about Keyera stock in the comments below. That's it for this video, guys. Thanks a lot for watching. Hope you learned a lot about Keyera stock. Let me know what you guys think about it in the comments below. As always, enjoy the rest of your day and see you in the next video.